When you first look at Bitcoin, it seems like a complete contradiction. It has no physical form, you can't hold it in your hand. There's no central authority backing it, no government seal of approval, no giant marble building with a chairman giving speeches on TV, and yet, for more than a decade, it has survived crashes, scandals, ridicule, and outright bans only to re-emerge again and again at the very center of one of the most heated debates in modern finance. So what is it? Is Bitcoin a serious investment asset, or is it just a sophisticated game of chance dressed up in fancy technological language? To answer that question honestly, we need to step back. We don't just need to understand what Bitcoin is, but more importantly, why it even exists. Bitcoin didn't come from a Silicon Valley boardroom or a Wall Street trading floor. It was born in 2008, right in the shadow of one of the worst financial crises in modern history. Banks were collapsing. Governments were rushing to bail out institutions they called too big to fail, and millions of ordinary people were paying the price for risks they never even agreed to take. Trust in the traditional financial system was shaken to its very core. It was in this moment of deep disillusionment that an anonymous figure, or maybe a group, known only as Satoshi Nakamoto, published a short paper. It outlined a radical idea, a new form of money that didn't need banks, governments, or any middlemen to work. A system where trust wasn't placed in institutions, but in mathematics, cryptography, and a decentralized network of participants. At its core, Bitcoin is a peer-to-peer digital monetary system. Instead of relying on a central authority to verify transactions, it uses a public distributed ledger called the blockchain. Every single transaction is recorded, timestamped, and verified by a network of independent computers all around the world. Once a transaction is recorded, it can't be altered or erased without rewriting the entire history of the network of tasks, so computationally expensive that it's practically impossible. This design alone was revolutionary. But what truly set Bitcoin apart was its monetary policy. Unlike traditional currencies, which can be printed or expanded whenever a central bank decides, Bitcoin has a fixed supply. There will never be more than 21 million Bitcoins in existence. No emergency meetings, no political pressure, no economic crisis can ever change that number. It is written into the code itself. To some, this makes Bitcoin a digital form of scarcity, kind of like gold, but native to the internet age. But to others, it raises a troubling question. How can something with no intrinsic physical value, no cash flow, and no issuing authority be worth anything at all? This tension lies at the very heart of the Bitcoin debate. In its early years, Bitcoin was dismissed as a curiosity, a toy for cryptographers and internet idealists. It was associated with obscure forums, experimental software, and niche online communities. Its price was wildly volatile, its uses were limited, and its future was completely uncertain. Critics pointed to its crazy price swings as proof that it was nothing more than a speculative bubble, just waiting to burst. And yet Bitcoin kept evolving. As the network grew, so did its resilience. More participants joined in, more computing power was dedicated to securing the system, and more developers started building tools around it. Slowly but surely, Bitcoin began to move out of the shadows and into public awareness. Exchanges emerged, digital wallets became easier to use, and the whole infrastructure supporting Bitcoin started to mature. With each cycle of boom and bust, Bitcoin attracted new critics and new believers. For skeptics, the volatility became the strongest argument against it as an investment. Prices could double in a matter of months, then crash by 70% just as quickly. Stories of overnight millionaires were matched by stories of devastating losses. To many observers, this just looked like gambling, not investing, a digital casino fueled by hype, fear, and pure speculation. But supporters saw something else entirely. They argued that the volatility was a symptom of youth, not a sign of failure. New asset classes, they claimed, often go through extreme price swings as the market struggles to figure out what their fair value is. They said what really mattered wasn't the short-term price movement, but the long-term adoption, the network security, and the integrity of its monetary policy. As the years passed, Bitcoin started to attract a different kind of attention. Institutional investors, hedge funds, publicly traded companies, and even pension managers began to study it. They weren't looking at it as a curiosity anymore, but as a potential asset. The financial media shifted its tone. Regulators, who were once dismissive, were now forced to engage with it seriously. Bitcoin was no longer just a fringe experiment. It had become too large, too influential, and too persistent to ignore. Still, the fundamental question remained unresolved. Does Bitcoin deserve to be treated like a legitimate investment asset, something that can play a rational role in a diversified portfolio? Or is it simply a modern expression of human risk-taking, driven by narratives, speculation, and the hope of extraordinary returns? To explore this question properly, we have to move beyond the headlines and our emotions. We need to examine Bitcoin through the same lens we apply to other assets: its economic properties, its behavior under stress, its risks, and its potential role in a broader financial system. But before we can do that, we have to acknowledge something important. Bitcoin is not just a financial instrument. It is also an idea. It represents a challenge to how money has worked for centuries. It asks whether trust must always flow through centralized institutions, whether monetary policy should be flexible or fixed, and whether individuals should have full, sovereign control over their assets without needing intermediaries. These ideas evoke strong reactions, both positive and negative. And those reactions often shape how people perceive Bitcoin as an investment, sometimes even more than the data itself. So, as we move forward, it's essential that we separate the myth from the mechanism, the speculation from the structure, and the belief from the evidence. In the next part of this series, we will take a much closer look at Bitcoin as an investment asset. We'll examine the arguments that support it as a serious, long-term store of value. We'll analyze how it compares to traditional assets like stocks and gold. And we'll explore why an increasing number of investors, both small and large, have chosen to allocate their capital to it. Only then can we begin to answer the question with clarity rather than emotion. Is Bitcoin truly an investment, or is it merely a 21st century game of chance? Is Bitcoin a serious investment? To answer that, we have to look past the headlines, the hype, and all the emotional noise. Instead, let's analyze it like any other traditional asset. We'll look at its scarcity, demand, utility, risk, and how it behaves over the long term. One of the strongest arguments for Bitcoin as an investment starts with its supply. Unlike regular currencies, which can be printed endlessly, Bitcoin has a hard cap. There will only ever be 21 million Bitcoins. This limit isn't set by a government or a bank. It's built directly into the code. New Bitcoins are created at a predictable, slowing rate through a process called mining. Every 4 years or so, a halving event cuts that rate in half, until eventually no new Bitcoins will be created at all. In economics, scarcity is a huge driver of value. Think about gold. It's valuable not just because we use it in electronics, but because it's rare, durable, and can't be easily faked or inflated away. Bitcoin shares these traits, but in digital form. You can't counterfeit it, you can't double spend it, and its supply is fixed. For investors worried about inflation devaluing their savings, Bitcoin offers an alternative with transparent, unchangeable rules. But scarcity alone isn't enough to create value. Demand is just as important. And Bitcoin's demand has changed a lot over the years. In the beginning, it was mostly technologists and early adopters playing with a new kind of money. Today, the demand is coming from a different place. It's from investors looking to diversify their portfolios, find a hedge against economic uncertainty, and own an asset that isn't controlled by any single country. You can see this shift in how big financial institutions talk about Bitcoin now. The question isn't, will Bitcoin survive? Anymore, it's how much Bitcoin should be in a balanced portfolio. Major companies are putting Bitcoin on their balance sheets. We have Bitcoin futures, ETFs, and secure custody services, all built to meet the standards of institutional investors. These things don't make Bitcoin risk-free, but they do show it as being taken seriously and carving out a legitimate space in the financial world. Another key factor is liquidity. For any asset to be investable on a large scale, you need to be able to buy and sell it easily without crashing the price. Bitcoin trades 24/7 on exchanges all over the world, and its liquidity is surprisingly deep, especially compared to other alternative assets. Yes, it's still more volatile than stocks or bonds, but its ability to handle large trades has improved dramatically. This makes it accessible not just for small-time buyers, but for big players managing huge sums of money. However, we have to talk about volatility. This is the biggest sticking point for critics. They look at Bitcoin's wild price swings, how it can drop by 50% in just a few months, and say it's just too unstable for a serious long-term investment. From their point of view, Bitcoin looks less like digital gold and more like a high-stakes bet on market sentiment. But supporters have a different take. They argue that this volatility isn't a permanent flaw, but a natural feature of a young, emerging asset. Think about it. In their early days, stocks and emerging market bonds were also incredibly volatile as the market figured out how to price them. The theory is that as Bitcoin matures and more people adopt it, that volatility will eventually calm down. And if you look at Bitcoin's price over the long term, you see this tension playing out. The short-term moves are dramatic, for sure. But across multiple market cycles, the trend shows a pattern of higher lows and wider adoption. For investors with a long-term view, this volatility is seen as the price you pay for the potential of massive returns, what they call asymmetric upside. This brings us to another important idea: correlation. One of the main reasons investors got interested in Bitcoin in the first place was that its price seemed to move independently of traditional assets like stocks and bonds. This made it a great tool for diversification because it could theoretically lower the overall risk of a portfolio. Now, that has changed a little. During times of major economic stress, we've seen Bitcoin's price move more in line with the stock market, which has made some critics question its diversification benefits. But the data shows a more complex picture. Bitcoin doesn't behave exactly like stocks, and it doesn't behave exactly like gold either. It's something of a hybrid, and its behavior can change depending on what's happening in the broader economy. In investment theory, you rarely judge an asset in a vacuum. You look at how it fits with everything else you own, how it performs in different economic situations, and whether it helps you reach your financial goals. From that angle, Bitcoin doesn't have to be perfect. It just needs to be a useful addition. Of course, no discussion about Bitcoin is complete without talking about the risks. And Bitcoin has unique risks that traditional assets don't. Regulatory uncertainty is a big one. Governments worldwide are still figuring out how to handle it, how to tax it, classify it, and what rules to apply. There are also technological risks, like potential software bugs or problems with custody and security. And let's not forget the behavioral risks, the panic selling, the excessive borrowing, and the herd mentality that can be amplified in a market that never sleeps. But again, risk alone doesn't disqualify something as a serious investment. Every investment has trade-offs. Stocks have business risk. Bonds have interest rate risk. Real estate has liquidity risk. The real question isn't whether Bitcoin is risky, but whether those risks can be understood, measured, and potentially rewarded with high enough returns. For a growing number of investors, the answer seems to be yes. They don't see Bitcoin as a replacement for their stocks and bonds, but as a small, calculated addition to their overall strategy. In that role, they're not evaluating it based on hype, but on its fundamental properties, its scarcity, the security of its network, its adoption trends, and its potential as a long-term store of value. And yet, despite all these logical arguments, the skepticism remains. Because even if you can analyze Bitcoin like an asset, it doesn't always behave like one. Its price is still heavily influenced by stories and narratives. Its market is still swayed by raw emotion. And for many people, Bitcoin isn't a strategic, long-term holding. It's something to trade aggressively for quick profits. This is where the line between investing and speculating gets very blurry. In our final part, we're going to tackle the uncomfortable side of this debate head-on. We'll explore why Bitcoin is so often compared to gambling, how speculation drives its market, and at what point an investment in Bitcoin crosses the line and becomes just a game of chance. Only by facing these questions directly can we get to an honest conclusion. Is Bitcoin a serious investment or just a high-tech game of chance? If you've ever looked at its price chart, you know why people ask. Those massive spikes followed by brutal crashes, the waves of euphoria and fear, it looks a lot like a casino. And honestly, that perception isn't entirely wrong. Bitcoin's market is a wild place. It runs 24/7 all over the world, with no one in charge. News, rumors, and even a single tweet can send prices flying or tumbling in a matter of hours. If you jump in without a plan, it can feel exactly like you're just rolling the dice. Plus, unlike stocks, Bitcoin doesn't pay you dividends. It doesn't have quarterly earnings reports. Its value is purely based on what someone else is willing to pay for it tomorrow. For critics, this is the very definition of a speculative bubble, valuable only as long as people keep believing in it. But here's the thing, belief is a powerful force in any market. The dollar in your pocket only has value because we all agree it does. Stocks have value because we believe companies will make profits in the future. Gold is valuable because for thousands of years, humans have collectively decided it is. Bitcoin is no different in that respect. Its value comes from a specific kind of belief in its code, its fixed supply of 21 million coins, and its ability to operate outside the control of any government or bank. So the real difference isn't about Bitcoin itself, but about how you approach it. For some people, it's absolutely a short-term gamble. They chase the hype, react to every headline, and try to time the market. In that scenario, yes, it's a game of chance. Your success depends more on luck and nerve than on any real analysis. And when people lose money this way, it's often not a flaw in Bitcoin but a result of their own impulsive behavior. But there's another group of people who see it completely differently. They view Bitcoin as a long-term experiment. A new form of money for the internet age. A hedge against inflation or an instability in the traditional financial system. They study how it works, they monitor the security of its network, and they see it as one piece of a much larger diversified portfolio. For them, the crazy price swings aren't a reason to panic. They're just the expected volatility of a brand new asset class. To this group, Bitcoin isn't a lottery ticket. It's a calculated position in a technology that could reshape the future. This is why the debate is so polarized. Two people can look at the exact same asset and have completely different experiences. One gets wiped out, the other sees their conviction rewarded over time. Bitcoin didn't change. Their strategy, their expectations, and their patience did. Another thing that fuels the gambling narrative is how easy it is to get involved. You can download an app and buy Bitcoin in minutes. There's no paperwork, no financial advisor, no barrier to entry. This is great for accessibility, but it also makes it incredibly easy for people to take uninformed risks. When you invest money, you can't afford to lose in something you don't understand. You're not investing, you're speculating. Then there's the whole issue of regulation. The rules are different everywhere you go. Some countries are embracing crypto, others are trying to ban it. This uncertainty creates more volatility, which reinforces the idea that Bitcoin is risky and unstable. But again, let's add some context. This is normal for any disruptive new technology. The early days of the internet were a regulatory Wild West too. Over time, rules get clearer and markets mature. Bitcoin's challenge is that it, as a global asset in a world still run by national systems. So where does that leave us? Is it an investment or a game of chance? The truth is, it's a hybrid. It's a new kind of asset that reflects the very nature of the person using it. If you approach it without a plan, without education, and without managing your risk, Bitcoin becomes a dangerous emotional roller coaster. In that sense, it's very much like gambling. But if you approach it thoughtfully, with clear goals, a long-term perspective, and an understanding of what you own, it can be a legitimate part of a modern investment strategy. The difference isn't in the technology or the price chart. The difference lies in your intent. Bitcoin forces you to ask big questions about money, trust, and your own responsibility. It takes away the guardrails of the traditional system and puts the control and the risk squarely in your hands. For some, that's empowering. For others, it's terrifying. And maybe that's why it sparks such strong feelings. Bitcoin doesn't promise to keep you safe. It doesn't guarantee returns. And it definitely won't protect you from your own bad decisions. But on the other hand, it doesn't inflate away your savings, change its rules on a whim, or discriminate against anyone. In the end, Bitcoin is like a mirror. It reflects the person who holds it. To the gambler, it's a casino. To the long-term planner, it's an experiment in sound money. To the reckless, it's a path to loss. To the disciplined, it's a calculated risk. So, is Bitcoin a serious asset or a 21st century game of chance? The most honest answer is this: Bitcoin becomes what you make of it. And that, more than anything, is what makes it both so fascinating and so potentially dangerous.